Hello everyone. Today I'm going to explain how the Priorities feature works in the MoneyReady app. In my last video, I explained how the time machine works in some detail. Today I just want to give you a quick summary of the first part and then expand on the priorities part. The time machine calculates all your incomes from external sources for the year and puts that in your wallet. Then from your wallet, it pays all your expenses for the year, including taxes. It then considers the automatic savings and withdrawals you set to make any deposit or withdrawals to or from your accounts. The end balance of the wallet is a surplus or a deficit that needs to be dealt with before moving on to the following year. Today we'll discuss how the time machine clears the wallet using your priorities, which tells it which accounts to use and in what order. For most, the default set on priorities are reasonable, so you may not need to change them. But for advanced users that want to try out many different scenarios, the priorities provide a lot of flexibility. Priorities are entered as tables, and there are two tables. The deposit priorities table is used to determine where to deposit a wallet surplus, and the withdrawal priorities table below is used to determine where to get money when there is a deficit. The order of the accounts in these tables determine the order in which the time machine will try the accounts from the top down. You can drag and drop the accounts listed to change their order. The rate of return of the account is shown for your information. You may want to prioritize deposits to high-yielding accounts and make withdrawals from low-yielding ones. There's also a limit column that I'll discuss later. If you have a spouse with their own accounts, they will have separate tables for their deposit and withdrawal priorities. Jointly held accounts and loans will be found in both spouses' tables. This is a recent change from before, as we used to intermingle the spouses' accounts. We used to do it that way, thinking 2 tables was simpler for users than 4 tables. But it resulted in more confusion. Having separate tables is a lot clearer. The time machine calculates separate wallets for each spouse, and one may have a deficit and the other a surplus. It goes through your priorities first to clear your wallet, and then your spouse's to clear theirs. There will also be 2 additional tables if you have an incorporated small business, and the CCPC holds multiple accounts and loans. The wallet for the CCPC is retained earnings. This is calculated by adding all the revenues net of expenses and then paying salaries and dividends as entered in incomes. Corporate taxes are calculated and paid from returned earnings. The priorities then determine where to deposit or withdraw the earnings. You set the priorities for this year, and they are maintained until you change them in a future year. In most cases, it's not necessary to change them, as the time machine will automatically switch between using your deposit priorities in years you have a surplus, say when you're working, and switch to the withdrawal priorities in years you have a deficit, like after you retire. If you've entered accounts or loans that begin in a future year, however, it'll ask you to set new priorities for that year, so that it knows where those new accounts fit in. The other reason you may want to change priorities in a future year are due to life events that may change your priorities. In particular, exceptional events like real estate transactions or inheritance, those can result in a temporary large surplus or deficit, and you may want to change your priorities temporarily for that year to deal with it. Allowing you to change priorities for future years gives you a lot of flexibility to explore different scenarios. Now let's consider the deposit priorities in more detail. The deposit priorities table includes your accounts that can accept deposits, but also your loans that can accept prepayments so that you can prioritize paying off your debt. It also includes an extra entry we call spending, and I'll describe that in a minute. First, let's go through an example. Say you have a surplus, and you want to deposit to your TFSA first, then your RSP, then to pay down your mortgage, and then to fund your non-registered investment account last. If the time machine calculates a 10,000 surplus, it first goes to your TFSA. But TFSAs have a limit imposed by the government, and the time machine has calculated your TFSA room and cannot deposit more than that. If you maxed out all previous year contributions, your room might be $7,000. So the time machine will put $7,000 in your TFSA, and the wallet balance is now $3,000. It goes to your RSP next, and again there is RRSP room to consider. Say it calculated a $1,000 RSP room, then it allows that to be deposited, and you're left with a $2,000 wallet. Then hits the mortgage. Again, your lender may have a limit on prepayments. You will have indicated that where you entered the loan in the app. If $1,000 can be prepaid, then $1,000 is left in the wallet. We reach your non-registered account, and there are no external applied limits to those accounts, so the $1,000 will get deposited there. That was easy. I said I would talk about limits, but all of the limits that are applied here were imposed. We did not need to set limits ourselves at all. This is often the case. However, you can also impose the limits yourselves with the limits column. The limit you set on an account defines the percentage of the amount left in the wallet when it reaches that account to be applied to that account. You would set a limit to 100% to deposit the entire current wallet balance, if it can, still up to any externally imposed limits, and you would set a limit to 0% to skip the account entirely. Here's an example. Say you just started saving and have lots of TFSA room. The entire surplus could go there, and the time machine would be done with your priorities. You can limit that yourself by putting a limit. If you enter 60 in the limit column, this tells the time machine to deposit only 60% of the surplus if it can, so $6,000 in this case. You would have set that limit because you also wanted to fund your RSP. And so then you can set the limit on that account to 100% to try to save the entire $4,000 remainder there. Often people make the mistake to enter 40% here, figuring I put 60% in the first account, so I should put 40% in the second to cover the rest. But the limit is applied only to the remaining surplus when you reach the account, not on the original surplus. So in this case, it applies to $4,000, not the original $10,000. I think you can see why it must be done this way. Externally imposed limits may have been applied to previous accounts. When setting your own limits, you don't need and shouldn't consider the limits you set on previous accounts at all. In this case, there's actually not enough RSP room, so the external limit on the RSP room is applied, and you still haven't a wallet balance. If the next priority is your spending priority, then you could have a limit on 100% on that to just spend the remaining $1,000. If you did not allow this spending and there was no more accounts below this priority, then funds would remain in the wallet until the following year, and you would get a warning in the time machine. The spending priority directs any surplus to be spent once savings and goals are met. It's for when you've decided you've saved enough and there's still many left, just let you spend it. Then you would set a spending priority to 100%. This feature is often used by advisors. They would set automatic savings entries for the amounts you invest with them, and then assume that all money not planned to be saved is spent. This way there's also no need to budget expenses. All income is either invested or spent. The spending is reported as unspecified spending in the detailed reports of the time machine. As I said, if there's still funds in the wallets once you've gone through the deposit priorities, they stay in the wallet until the next year, and a warning is issued in the time machine. This is rare. It usually indicates that you overly limited deposits, or you may need to add an account to accept deposits. You may need to add a non-registered account, for example. You may not have one now, but you may need one in the future when you've maxed out TFSA and RSP room. This is true for spouses, too. You can make your registered account joint so that your spouse can use it, too. The order of deposit priorities is most important, and there are usually government limits imposed on deposits to registered accounts. So you don't need to impose your own. Usually people want to save as much as possible, so the spending priority is set to 0% by default. If you do set your own limits below 100% on your accounts, remember that percentage is applicable only to the surplus remaining when you reach that account. The withdrawal priorities and limits work the same way. For example, if you have a $10,000 deficit now, the time machine will try to take it from the first account in the withdrawal priorities table. If that's your non-registered account with a limit set of 100%, they will try to take it all from that account. There's no government limits to consider for a non-registered account, but what if you do not have $10,000 in the account? If you only have $6,000, it's the balance in this case that determines the limit for the withdrawal up to the account balance. So in this case, there would be $4,000 left to withdraw from the next account down, say a tax-deferred account. If it's a locked-in account, again, there might be external limits imposed. If any withdrawal is made at this point, it will be on top of any required minimal withdrawals already made by the time machine. If the withdrawal is fully made, then we are done. No need to withdraw from the TFSA that is next. I think that you can see that over the years, those three accounts will be depleted in turn. That may not be the most optimal withdrawal strategy to minimize taxes paid over your retirement. So you can try other ones to see if you get a better result. A popular strategy, for example, is to set a limit of 50% on the non-registered account, then 100% on the RSP to withdraw the rest, and then 0% on the TFSA to never deplete it and leave it all to your kids. However, if you still have a deficit at the end of this, you will get a warning in the time machine. Because then you have a cash flow problem. The deficit is covered by the time machine like a temporary loan, but it adds it to the next year's expenses to see if you can pay it back and recover. Withdrawals from accounts are a lot less limited by the government, and so you have a lot more flexibility. Additionally, you may have lines of credit that you have set to be accessed if needed. The flexibility allows for more exploration of different scenarios to find an optimal withdrawal strategy. But that is actually a very hard problem, and we have the withdrawal optimizer to do it for you to make that easy. The way the withdrawal optimizer works is that for all years after retirement, a sophisticated algorithm will find an optimal withdrawal strategy that maximizes your after-tax legacy. The time machine tries that strategy instead of yours, and if its strategy is better, that is, it leaves you with a larger after-tax legacy, then it will show you those results. It will warn you that both your set automatic deposits and withdrawals and your priorities were ignored because it used its own strategy. Using the withdrawal optimizer tool is the easiest and the fastest way to find an optimal withdrawal strategy or to check that the strategy you set up is near optimal. Your first method of controlling deposits and withdrawals in the time machine are the automatic savings and withdrawals you can enter to force them. Priorities only clean up the wallet after all has been done in the year. Deposit priorities determine where surplus is deposited or if it's spent. Withdrawal priorities determine where funds come from to clear a deficit. Finding an optimal withdrawal strategy is a very hard problem, so use the withdrawal optimizer to check that your withdrawal strategy is optimal. If you have any questions, please use our contact page and I will be happy to answer them. Thank you.